Not put your money to work.
Put my money to work?
That's right, Mr. Finchley. You can own a share of American business. There are over 1,200 companies listed on the New York Stock Exchange.
To understand the Great Recession, we first need to have a basic idea of supply and demand. As price goes up, demand goes down. As demand goes up, stock goes up. As stock goes up, price goes down, and equilibrium is met, meaning both the consumer and the seller is happy. This is the way the house market usually works. In 2007, though, this changed drastically. Leading up to the Great Recession, the U.S. Federal Reserve changed the return rate to just 1% to better benefit the economy. Now, this drove away most of the investors that would put their money into the U.S. Federal Reserve and hope to get a little return back later. Instead, the investors needed to find a new place to go to. And what did they figure out? Real estate. By putting money into real estate, you almost get a guaranteed return because by paying a mortgage, you can guarantee that the person is going to have to pay it back with interest, meaning both the bank then gets money and the investors. It's a for sure investment. Banks started to be able to borrow a lot more money than they could because of that 1%. This means that 1% return rate was all that the U.S. Federal Reserve got when they took out money. So they could get money a lot cheaper and a lot easier, meaning pretty much anyone could take out money from a bank. The investors needed more money because they are greedy, obviously. So they wanted more people to invest in mortgages. They wanted more people to buy mortgages so they could pay them, and they would eventually pay them back. Again, giving interest to both them and the bank, making them both rich. The bank's answer to this question was, why don't we start giving people that are a little less reliable with mortgages? Now, these people were not guaranteed to get pay back their mortgage, and they're what you like to call a subprime mortgage. They expected these people not always to pay back their mortgage, and that would be okay, because if they don't pay back their mortgage fully, then the bank gets control of the house. Then they can just sell that house. However, this did not go exactly planned. A lot of these people that got these new mortgages, these subprime mortgages that the investors were so happy people were taking out, none of them really got paid back. Now, the investor is still okay because he's getting the house, but when no one pays it back, then that means the bank gets all the houses. And when the bank can control most of the houses, then they put them up for sale, and there's so many houses for sale, then the price goes down because there's so much supply. Equilibrium is not going to be met in this scenario because no one is interested in buying a house. Anyone who has a house usually already has a house. So when you flood the market with houses for sale, the price goes down very low because there is literally no demand for that, and there is so much supply. This is basic supply and demand, but this is not really exactly going well like the bank or the investors thought it would. So just imagine there's a billion houses for sale, and you have your house. Now, all these houses are usually maybe $300,000 houses, $400,000 houses, and they're only worth about $100,000. Your house now goes down in value, because if someone wanted a house, why would they buy your house that's going to cost a lot more money when they could just go buy one of those houses that are $100,000? So now your house now goes down to a value of about $100,000. This isn't good because you're paying a mortgage of about $300,000, $4,000, for example, when your house is really only worth $95,000. So what do? They just stop paying their mortgage, put their house up for sale. The banks lose a lot of money. They go into bankruptcy because they don't have money, and they're taking so much money from the Federal Reserve to start paying these mortgages and keep their operations running that now they can't pay that back because no one's paying back their mortgages, and they're stuck with just a ton of houses that are for sale. $50,000 house. Why do they keep doing that? They just quit. They say, no more of this. They put their house out for sale. They stop paying their mortgage. Now they're just looking at a ton of $75,000 houses, but they can't pay that back because the house value is incredibly low. Ton of houses out for sale, $75,000. No one wants them, and it's just, that was recession. That's recession right there. Banks are poor, peoples are poor, no one's paying back mortgages, no one paying back loans, the bank has a debt crisis on their hands. That's recession. So I hope you enjoyed this video. If it didn't explain the recession very well, because it's my first video and you should subscribe, then I'm sorry. Ask a question in the comment section below, and I will hopefully get back to you. Well, I will get back to you, because I know there's going to be like 3 people that comment. But if you're one of those 3 people, guaranteed an answer from me, and I can hopefully help you explain the recession.